Welcome to the Depth Dive. Today, we're really getting into the weeds with Ramkrishna Forgings Limited. That's RKFORGE. We've pulled together quite a bit here. Their latest investor presentation, Q2 and H1 FY26 results, plus recent news and the technical stock charts, too.
That's right. And our mission, really, is to sort of cut through all that data to get at this core tension. How is RK4G trying to navigate all this global volatility?
Yeah.
You know, they've got these big, ambitious expansion plans, new markets, new products, but they're also facing some serious short-term pressures. Profit drops, market turbulence. It's a lot.
It is. So we're trying to blend like three different angles for you. There's the company's own story from their presentation.
The corporate narrative.
Then there's the market reality, what the stock price is actually
That it tells its own story.
And finally, the operational timeline, what's actually happening on the ground with these big projects over the last 6 months or so.
Right. Trying to see if the strategy lines up with the reality and if it's enough to fight off these headwinds they're facing.
Exactly. So let's maybe start with the financials. That seems like the best place to see the pressure points.
Good idea. Let's dive straight in.
Okay, so headline numbers first. Consolidated results for Q2 FY26. Revenue from operations was 90,753 lakhs.
Which is about, what, 907 crores? That's up 14% year over year. Looks pretty decent on the surface.
Yeah, 14% growth isn't bad. And EBITDA was 12,254 lakhs, keeping the margin around 13.5%. So you glance at that, you think, okay, they're holding up.
But that's where it gets tricky. You look just below that at the profit line, and it's a completely different story.
Right. This is where that persistent global volatility they talk about really bites.
It really does.
Right.
Because the news sources we looked at confirm that despite that revenue growth, Q2 FY26 actually ended with a consolidated net loss of 9.50 crore.
Wow. Okay. So from profit to a 9.5 core loss, even with higher revenue, that's quite a swing.
It's huge. It tells you that growth came at a really high cost. Rising expenses, margin compression, something squeezed the profits right out.
And the MD, the managing director, kind of acknowledged this, right? Mentioning the tough environment.
Yeah, they specifically pointed to persistent global volatility, geopolitical stuff, currency swings, input costs going haywire, basically admitting it was incredibly tough to make money this quarter.
So it's less about resilience and maybe more about strategic pain, absorbing costs.
That's what it looks like, especially when you factor in the order book. This is the fascinating part.
Okay.
Despite the loss, despite the pressure, they booked new orders worth 1,116 crore just in Q2.
1,116 crore, that's substantial.
It's huge across auto, non-auto, and especially railways. So what this tells you is customers are still signing on the dotted line. It suggests maybe management is taking a hit now to secure these long-term deals, banking on diversification, paying off later. Customer trust seems pretty strong.
Okay, but that customer trust, it seems. Well, it depends where you look, doesn't it? The data shows a really clear split between domestic and export markets.
Oh, absolutely. That global volatility isn't just talk. It's hammered their export business. It's stark.
How bad was it?
Really bad. Standalone exports, Q2 FY26, down 32% year over year.
32%? Ouch.
Yeah, and even for the first half, H1, still down 25% year on year. I mean, 32%.
Yeah.
That's not a headwind. That's like a major storm hitting your international sales.
Wow. And they blame this on U.S. tariffs.
Primarily, yes. U.S. tariff-related uncertainties. They did add that their overall exposure is, quote, limited, and they hope for a trade agreement to sort things out.
Limited exposure, but a 32% drop. Does that fully add up? Or could there be other competitive pressures at play, too?
That's the million-dollar question, isn't it? You have to be a bit skeptical. Is it just tariffs? Or are they losing ground for other reasons in those markets? Hard to say for sure from the outside.
Right. But whatever the exact cause, that export collapse is the complete opposite of what's happening domestically.
Exactly. The domestic market is the anchor right now. It grew 8% year over year in the first half, H1 FY26.
Okay, 8% growth. Not spectacular, but solid.
Solid, yeah. And the MD pointed specifically to good momentum in the railway segment driving that.
But this overall picture, especially the weak exports, it must be hitting their production levels, right? Their factories.
Definitely. You see it clearly in the capacity utilization numbers. It just cratered.
How far did it fall?
Total capacity utilization dropped from 87% in Q2 of last year down to just 60% in Q2 this year.
87 down to 60. That's a massive drop, almost 30 points.
It's huge. And think about what that does to your costs. Your fixed overheads, rent, Machinery depreciation, all that stuff suddenly gets spread over much less production.
Meaning the cost per item goes way up, squeezing margins even more.
Precisely. It becomes a drag on profitability.
Okay, so this pressure, falling utilization, collapsing margins, export woes, it explains why they're making these big strategic shifts, right?
Absolutely. It feels like they're trying to, change the engine while the plane's in flight. They have to pivot into areas less exposed to these global cycles.
And railways seems to be priority number one.
It really does. They're not just talking about it. They've gotten approvals, started bulk shipments of these fully assembled bogie frames.
Okay.
Plus, they've launched a whole new vertical just for supplying castings to railways. Apparently, that's started well.
But the really big one is the wheel project, isn't it?
Oh, yeah. The Rail Wheel project. That's potentially transformative. It's a joint venture with Tikagar Rail Systems. RKFL has the majority, 51% stake,
And the goal is?
to build basically Asia's second largest plant for forged railway wheels.
Right.
We're talking 228,000 wheels per year.
Wow. That's a massive undertaking. Where's this happening?
Not in Chennai. It's underway now, and they expect operations to kick off by March 2026.
So this is a huge bet on becoming a core supplier for Indian Railways, a massive, guaranteed domestic customer, presumably.
Exactly. It's diversification and locking into critical national infrastructure. Very strategic.
And at the same time, they're tackling that tariff risk directly with the move into Mexico.
Yeah. Hedging their bets. They bought a company around Krishna Forgings, Mexico, SADCV, and already started machining operations in Monterrey, leased factory space there.
Bringing production closer to North American clients.
Precisely. And it's already paying off, seems like. They've apparently secured orders worth 200 crores over 5 years for machining services from a major North American customer.
Starting April 2026.
Bulk production starts then, yeah. So that's a concrete step to sidestep future trade issues.
Okay, so Railways Mexico. What about technology, EVs?
That's the other big push. They're installing a new specialized 3,000-ton press specifically for aluminum-forged components.
Aluminum. Lighter weight for EVs.
That's the target. Directly aiming to grab more business from the EV market and also looking at new products for domestic and light commercial vehicles, LCVs.
LTVs often electrify faster, don't they?
Often, yeah. So it makes sense.
Yeah.
And then there's the whole new castings plant, 45,000 metric tons per year capacity. That's supposed to be commissioned in the second half of this fiscal year, so pretty soon.
So rail, Mexico, EV components, castings. That's a lot happening all at once.
It really is.
Yeah.
Huge execution risk, massive capital spending. But if they pull it off, the company is forecasting pretty strong volume growth for the second half, like 18 to 20%.
18 to 20% volume growth. Okay, that's ambitious, given the recent numbers. Depends on hitting those project timelines, I guess.
Absolutely. It all hinges on execution.
All right, so the strategy sounds, logical on paper, big shifts, addressing weaknesses. But when you look at the stock chart, well, the market doesn't seem convinced yet, does it?
No, not at all. The technical picture is, frankly, pretty bearish.
Right.
The market's clearly focused on the immediate pain, the volatility, the losses, the execution risk.
How bad does the chart look?
Well, the stock's in a confirmed downtrend. Over the period we looked at, it's down around 38.85%. That's a significant drop.
Almost 40% down.
Yeah. And the key long-term indicator, the 200-day moving average, it's well above the current price and is sloping downwards. That just confirms the strong bearish sentiment over the longer term.
So investors aren't pricing in the potential success of railways or Mexico yet. Not in the long-term view, anyway.
Doesn't look like it. The market seems to be saying, show me the money first.
What are the key levels, then? What does the stock need to break through to change that narrative?
There are two main hurdles, technically speaking. First, there's immediate resistance near the 50-day moving average. That's around 555 rupees. That's like a short-term mental barrier.
Okay, 555.
But the really big one, the level that would signal a potential shift in the medium-term trend, is the 200-day moving average. That's up around 639 rupees.
639. So until it gets convincingly above that level, the bears are still technically in control.
That's generally how technicians would read it, yes. The overall downtrend remains dominant below that.
But you said overall, is there anything positive in the shorter term? Any signs of life?
Actually, yes. Despite that gloomy long-term picture, there are signs of emerging short-term bullish momentum.
Oh, like what?
Well, there's been a recent uptick in price, and importantly, it happened on higher trading volume, which suggests conviction.
Okay.
And the RSI, the Relative Strength Index, which measures momentum, It's bounced pretty sharply. It's currently sitting around 64.95.
Was 64.95 high?
It's getting up there. It's not yet overbought, which would signal exhaustion, but 64.95 definitely indicates strong recent buying pressure. It suggests maybe some investors are starting to react positively to the strategic news, even if the long-term trend hasn't turned yet.
Interesting. So a bit of a disconnect between the short-term buzz and the long-term chart damage.
Exactly.
Okay, so alongside these huge operational shifts, they're also doing some internal housekeeping, right? Streamlining the company structure.
Yeah, tidying things up. There's that planned merger of two subsidiaries, Mel Metallics and Multitech Auto, into another one, Ramkrishna Casting Solutions.
And that's happening soon.
Expected this quarter, Q3 FY26. It seems like a straightforward efficiency move. Simplify the group structure, cut down on duplicate paperwork and compliance costs, get better synergy between casting and machining.
Makes sense, especially if they're gearing up for big growth in railways and EV parts,
Yeah.
reduce internal friction.
Exactly. Just makes the whole machine run a bit smoother, hopefully.
And finally, what about ESG? Environment, social, governance, that's increasingly important, especially for global companies.
It is. And they seem to be taking it seriously, setting some pretty ambitious, measurable goals, like net zero emissions by 2040.
2040, okay.
And also zero liquid discharge ZLD across all their plants by 2030. That means recycling basically all their wastewater.
Those are significant commitments. Are they showing progress?
They are reporting metrics, yeah, like a 6% increase in renewable energy use recently. Their Kolkata head office is apparently run on 100% green energy now.
That's good.
And importantly, from an operational efficiency standpoint, they cut energy intensity, the energy used per unit of production, by 9%. That saves money and helps the environment.
Right. And on the S&G side, social and governance.
They mentioned training 99% of permanent employees on human rights principles, and they got certified as a great place to work for the second year running. So they're definitely highlighting these aspects.
Which, as you said, can be crucial for winning business with big global partners who have their own ESG standards.
Absolutely. It's becoming table stakes in many industries.
Yeah.
Hashtag outro.
Okay, so let's try and wrap this all up for you. It's a company under intense pressure, isn't it?
Immense pressure. You've got this immediate, really painful situation, a net loss in Q2, exports falling off a cliff seemingly due to tariffs, factory utilization way down.
Yeah, the short-term picture looks pretty tough.
But countering that, they're making these huge, almost make-or-break bets on the future.
Right, the rail wheel JV, the Mexico machining plant, the big push into aluminum forging for EVs.
Exactly. These are massive, capital-intensive, long-term plays designed to shift the company away from its current problems and into potentially high-growth, maybe more stable segments, de-risking, essentially.
And they're pinning their hopes on these new ventures kicking in fast, projecting that 18–20% volume growth in the second half of this year.
Which sounds great, but it leads us right to the critical question you, the listener, need to keep in mind.
Which is?
Given that the stock is still technically in a long-term downtrend, with that big resistance level way up at the 200-day average, how fast do these new strategies, railways, EVs, need to start delivering actual results? Not just volume, but profit margin recovery.
Right. Can the good news from the strategy overcome the bad news from the headwinds and the market volatility quickly enough to turn that stock chart around?
That's the crux of it. The timing of that payoff versus the ongoing pressure. That's what will determine if RKFORGE can actually pull off this escape velocity they're aiming for.
A really fascinating situation, a company making huge changes in a very uncertain world. Thanks for walking us through it.
My pleasure. Lots to watch there.